Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
I'm Dylan Smith, and this is the Rosenberg Roundup. He's back. Jacob makes his grand return to the show this week, and I've noticed a certain glow of nuptial bliss about him. Jacob, how are you?
I'm doing great, Dylan. The wedding went off without a hitch, and Dave himself delivered a killer wedding speech. Although I think there was enough embarrassing material in there about me that I'd probably like to spare you and our listeners from.
Good to hear. Well, we hate to admit it, but we did miss you a bit on the pod, so good to have you back. Lots to cover today, so we won't overdo your welcome. Let's get into it.
Yeah, good idea. We're going to kick things off today with an overview of the latest market updates and data, and that's also going to include a bit of an international roundup. We're also going to shine a spotlight on the vaunted but often misunderstood wealth effect.
And of course, it was budget day in Ottawa on Tuesday, so we'll have to pay a little visit to Canada Corner. I thought I'd welcome you back in style, Jacob.
Well, I'm excited for that as always, Dylan. With that, let's get going with the week in review. To start things off, why don't you fill us in on what's been happening in the markets lately? Certainly a lot to catch me up on from the last couple weeks.
Absolutely. Over the past couple of weeks, we've definitely seen a bit of a change in the trends that define the first few months of the year. And that's mostly down to how investors' views on the Fed and the rate cutting cycle are evolving as the data comes in. Probably the most glaring move you should be aware of, Jacob, is there's been a sharp rise in treasury yields as traders and investors have come to the view that we won't see rate cuts in the near future. It's helped that Powell and other Fed officials have made that explicit in recent speeches, and that's helped markets price in a near certainty of no rate cuts in June. And in fact, in about 3 weeks, over the last 3 weeks, implied market pricing for the June cut has gone from an 80% chance that they will cut to an 80% chance that they won't. And even July is now looking 50-50. So as a result of that, we've seen the 2-year T-bill pick up about 40 basis points over the course of April. That's a big move, and the 10-year has picked up around the same amount. That move in the US has only been partially matched by global bond markets, so that means that spreads have widened, and the US dollar has been left a lot stronger. In fact, it's touched its highest levels on a trade-weighted basis since early November. Higher rates, of course, tend to harm corporate profitability and growth, so that move in treasuries has bled into equity markets too. In fact, there's a bit of a reversal underway that's gaining some real momentum. At time of recording, we're almost back down to the 5,000 threshold on the S&P 500, erasing most of the gains that we've seen since all the way back in mid-February. And as we've warned before, the snapback from a bull run that is primarily sentiment and momentum-based, which is what we've seen in the beginning of the year, can be very sharp and very fast indeed.
And how's gold doing? That seems to be top of mind for much of our audience.
Well, amazingly, against that backdrop, gold has actually held up. Usually, a stronger dollar and higher interest rates means that you're going to earn more money by just holding cash, and that reduces investor demand for gold. But there's been a lot of offsets going on that have supported the gold price around the 2,400 level or just below. The big one, of course, being the steady ratcheting up of political tension in the Middle East this week with Iran's drone strike on Israel. There's also all that demand we've been highlighting for physical gold coming from central banks and emerging market investors and even retail markets in emerging markets. That's all still in place and supporting the price, as well as the tight supply conditions. So at the same time, we're also getting a sense that investors are cottoning on to the fact that the U.S. fiscal outlook is deteriorating steadily as it becomes clear that neither party who might win this year's election actually has debt reduction as a governing priority. We're either going to get more spending or tax cuts, depending on who ends up in power. So all of that's supporting the gold price, but just imagine what will happen when big investors start getting seriously interested in gold and ETF flows into gold turn positive rather than negative.
Yeah, it makes perfect sense. And I know you have a key view that gold's going to cross the 3,000 mark, and I think you have that as a pretty big factor. So let's move on then. Feels like it was a lighter week in data, but maybe you can touch on some of the more interesting global developments that took place.
Yeah, it was a little lighter, especially after last week's drama with the CPI. But we did have a strong March retail sales report to kick off the week. That's been part of what's fueled the reevaluation of Fed cut timing, actually, and driving further losses in treasuries. But the details behind that retail sales report were actually a little thin, despite a fairly strong headline number. And what we're seeing there is similar to what we're seeing in a lot of other data, including inflation, which is that any subsector that is very cyclically sensitive, we would say, so anything that responds a lot to higher interest rates, we're seeing a lot of weakness there. So in this retail sales report, it was things like autos, furniture, both often bought on credit, sporting goods, electronics and appliances, and so on. A great deal of weakness, and that's being offset by basically a big rise in online shopping. And weirdly, the category miscellaneous showed a huge boom. So, we don't think that's a particularly strong report once you get into the details, but of course, markets mostly respond to a fairly strong headline.
We also have Q1 GDP next week, so that figures to be another big pivot point for markets.
That's right, and a fairly wide spread there on what different models are showing for the potential outcome on GDP. Our own internal nowcast has a very poor view on the investment numbers for GDP, and so is actually tracking negative right now. And various other models are a little stronger, and economists perhaps a little complacent, and all basically predicting 2%. We also had this week the Beige Book, which is the collection of reports from the different branches of the Federal Reserve Bank and what they're reporting back from their business contacts in the region. It wasn't the highest quality report, fairly poor signal, lots of sort of cross currents in it. Maybe a little better on aggregate than the last edition, which showed a bit of a tank, especially in the services sector, but essentially a mixed report. One quote we were very interested by, though, was one that essentially showed that businesses are really struggling from a profitability perspective because they're seeing demand flagging and they're struggling to pass on any price increases to consumers. So very positive for the inflation outlook, but also suggesting consumer demand maybe weakening a little bit. And I wanted to look abroad, though, because I think a lot of the important data we've had this week actually hasn't been US data. A lot of the data contributing to this idea that there's a big divergence going on in the policy outlook for the big central banks. So, for instance, we had a big downside surprise in UK employment data, already big downside surprise, which has set up the Bank of England to follow the ECB and the Swiss on the path towards cuts. We had a very good drop in Canadian inflation too. All core measures pretty much back to target. And that's exactly what Governor Tiff Macklin ordered up in his last press conference. So they're also set to cut before too long. And those things collectively are why the dollar is so strong. The last thing I'd point out, keep an eye on China. We know about the solvency issues in the property sector. We know that manufacturing has been weak. But we're also now already starting to see mounting evidence of consumer demand dropping off. Confidence is really waning for the Chinese consumer. And there's an increasing tendency to switch towards cheaper local brands from foreign brands. So we've seen iPhone shipments down, and we've seen some of the luxury retailers struggling as well in that market.
With that, let's move along to this week's Spotlight. There's lots to choose from, but the piece we selected to highlight this week comes from our colleague Atakan Bakishkan, who published some great research on the wealth effect. So let's start there. What is the wealth effect? Why is it important?
Yeah, great research from Atakan. Essentially, the wealth effect is this very simple idea that when households get wealthier, i.e. when their assets go up, we're not talking about their ordinary income here, but when households get wealthier, they spend more. And on aggregate, that matters a lot for the economic cycle because that can be a large source of income. It's a very intuitive idea, especially in the US, but for various technical reasons, it's actually very hard to estimate how big it is. And that's where our colleague Atakan did some great work applying some cutting-edge econometric techniques to figure out how much of a role the wealth effect is currently playing in driving the economic cycle and keeping spending high in the U.S.
Maybe you can help us all understand that a little bit more, because I think it's easy to assume that all the best investment advisors are going to tell you to reinvest your returns when the markets are doing well.
Sure, they'll say that, but it's not always what happens, right? And I think it's actually useful to break down the wealth effect into two separate components, the two kind of big sources of wealth. One is housing wealth, and the other is portfolio wealth, so how much you have invested in the markets. And generally, that mostly goes up and down with the stock market, to simplify it a little bit. And that makes it a little easy to understand because you can see how both of those effects would cause people to spend more, right, if wealth goes up. On the housing side, Higher prices mean you can borrow more against the value of your house. You have better collateral. You can take mortgage equity out, and you can fund either improvements to the house itself, which is a form of spending, or it can fund all sorts of other things. And on the portfolio side, we would think of the wealth effect actually getting stronger in recent years via two channels, really. The first is that the big generation of 401k retirees is just coming into retirement. They don't have defined benefits that are fixed in the way that previous generations have. So their ability to fund their retirement and the degree of discretionary spending they have in their retirement is actually very closely tied to the market. The basic idea there being that, Grams will buy you a nicer birthday present if she's not worried about her retirement savings eroding. And even sort of slightly harder to prove effect is what's happening with the generation on the other end of the scale, the Robin Hood day trading COVID investing generation who play the markets and do seem pretty willing to take their earnings out to fund current expenditure. The most extreme example there being, the Bitcoin bros and their Lamborghinis. Both effects have as well what we would call a sentiment channel. So there the idea is if you feel richer, you feel a bit happier, you'll probably just spend a little more as a result. You'll take a holiday, you'll eat a nice meal instead of being stressed and carefully saving money. And to preview our findings, Americans are taking a lot of holidays right now, and their savings rate is way, way down. So that effect probably is important at the moment.
What would you say was the overall takeaway for our listeners?
Okay, here's what our estimates showed. Right. If you take the cumulative increase in home prices we've seen since COVID, combined with the recent bull run in equities, you have the wealth effect currently adding around 2.5 percentage points of growth to personal consumption expenditures. And so that's around just under 2% to GDP. Now, in terms of where the rate of change is, the housing effect has been kind of gradually fading. It's a bit slower moving, but still positive. Whereas the big bull run that we've seen in the beginning of this year has meant that the portfolio effect currently is pretty massive. And that's what we'd attribute any upside surprise to growth to as we get the GDP numbers next week. There are full details and beautiful charts in the report, obviously, but it's worth emphasizing what this all means and kind of what's behind this very pervasive soft landing, resilient growth narrative in the US, which is that as this massive fiscal stimulus that we've had for the past couple of years is set to fade, a big wealth effect has sort of jumped in just in time to support spending and growth as stocks have run up. But that could reverse at any moment, right? A period of weaker markets or, even a bear market would massively reduce that wealth effect and turn it negative. And meanwhile, everyone who doesn't have any wealth stored up is trading down and relying a lot on credit cards and buy now, pay later and what have you to fund their expenditure. So sure, spending's been frothy, but I'm not sure it's what we'd call resilient necessarily, and we'd have to flag that risk. Another thing, the Fed won't be able to cut until it knows that the big bull run is behind us. That's a huge takeaway from our research. Okay, moving on. Jacob, I've just realized that we haven't given you your office wedding gift yet. So on behalf of the whole team, here you are, a one-way ticket to Canada Corner, non-refundable, departing immediately. I know it wasn't on your registry, but we do like to go above and beyond.
Oh, how lovely. How generous of you, Dylan. Thank you so much. And I would say no better place for a honeymoon. But anyways, let's get into it. I want to start by asking you to talk a little bit about the budget that Trudeau and his Liberal government presented this week. So give us your thoughts on that.
Sure. We gave the budget a D+ grade. So not a great budget, and I wanted to explain why. But maybe for context, we'll start by saying why it wasn't an outright F. And that's because Canada kind of has a starting point where it's in a better fiscal position than most of its peers globally, with the combined federal and provincial debt to GDP ratio of around 90%, whereas almost everyone else in the G7 is over 100. We've also had growth coming a little stronger than was expected in last autumn's statement, and so there was a bit of fiscal room to play with. And they did use that wiggle room, basically, which is why we didn't like the budget, right? Just because you have a bit of space doesn't mean you have to use it. And in fact, a responsible government will hope to maximize that extra space. But instead, we saw a 53 billion Canadian dollar rise in spending over the next 5 years. Now, a lot of that spending is fairly good spending. Lots of focus on incentives to increase housing supply. Also, some more funding for the health system and social spending generally, and upping the defense budget in line with Canada's NATO obligations. But there was no effort to rein in other spending to match that shift in priorities. Instead, we got a tax increase on capital gains. And while the budget document itself went to great lengths to show that Canada has, a reasonably low tax burden on this front, and sure, it's a progressive form of tax, it's just not the right time to be imposing this kind of tax on the Canadian economy. Real income per capita is negative in Canada, so there's an income recession underway. A lot of that's because of very high immigration levels, where absorption is becoming a problem. There's a huge productivity slump as well. And essentially, this type of measure harms competitiveness and discourages investment in Canada. The startup community was particularly incensed by the budget. They rely heavily on the promise of large capital gains to bring in early-stage investors and attract talent. And so if you're thinking of Canada's position in the world in terms of startups and AI, a very key time to be doing everything you can to get those businesses moving. So overall, we thought, while there's nothing disastrous in the budget from a macro perspective, it showed a lack of discipline and a missed opportunity, really, to improve Canada's fiscal footing as it comes out of those very, very loose COVID days. It's also, by the way, going to make the Bank of Canada's job a little bit harder in terms of its ability to normalize policy early and quickly. And so the two branches of government, they're not quite in sync on what the macroeconomy needs right now.
Thanks, Dylan. And with that, I think it's time to wrap up. For our listeners, please don't forget to subscribe and leave us a review. It really helps us keep the podcast going. Next week, we're actually going to have a special episode featuring the enigmatic investor David Hay. That one's going to be released midweek, so make sure to keep an eye out for that. But until then, I'm Jacob Rosenberg.
I'm Dylan Smith, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.